So what we're going to do is we work for Eastdil Secured, which is a real estate investment banking company based out of New York. So you can go through and look at these people. The thing that I love about this company is it's not only real estate brokerage, but they also do investment banking. So they'll work with very large clients to basically structure the capital structure that we talked about last week in regards to financing the assets in which they acquire, their clients acquire and develop. Okay, so they will put together the financing and they'll do the brokerage. So they're doing investment banking and they're doing brokerage, okay, at a very high level for institutional level clients. And that's what I think is great about these guys and women, is that they can basically solve any problem. They can find the property, they can negotiate the property, they can negotiate the debt that's going to be issued to finance the property, they can negotiate and issue the equity that's going to finance the acquisition of the property or the development. They can actually negotiate with the banks to be able to secure the construction loans and also the permanent loans on the back end. They also have institutional clients that will co-invest equity alongside the developer. Okay, so I would go through the site, learn about these people, learn about what they do, who they are, the types of transactions that they do, their business lines. As you can see, they do investment property sales, they do debt placement, investment banking, equity, structured transactions, corporate real estate transactions, mortgage loans. They do everything. Okay, so this is like the top investment bank, and actually it's owned by Wells Fargo. So it's a separate division of Wells Fargo Bank. And this is their real estate investment banking line. And again, you can see the different property types that they work in. This is the one that we're going to do right here, is basically industrial R&D. And then you can look up the press releases on the deals that they've negotiated, and then where they're located. So we're going to be the investment bank. We're going to pretend like we're Eastdil Secured, and we're going to work with the Alexandria REIT. Okay, so go look up Alexandria REIT. Alexandria is a publicly traded real estate investment trust, or an REIT. Equities.
ARE.com.
What is it?
ARE.com.
ARE. Okay, thank you. So the reason why I picked Eastdil is one of the top real estate investment banking companies in the United States, based out in New York, and they have an office in San Francisco. And the reason why I picked Alexandria REIT is they're one of the biggest biotech, biopharma, biomedical real estate investment trusts, publicly traded, kind of a niche. They're the ones who basically bought and master planned Mission Bay. Do you guys know Mission Bay in San Francisco? Yes? No? Mission Bay, UCSF, Genentech. The whole area is basically biopharma, biomedical. And what we're going to do is we're going to pretend that we as Eastdil are the investment advisors on behalf of Alexandria REIT to take the land that Alexandria already has and build a 1 million square foot biomedical campus with labs and medical office space. It's going to be 1 million square feet million square feet project. And it's going to cost $1,000 a square foot to basically build. What's the size of that? What's the dollar amount of that? It's $1 billion. So it's a $1 billion project. Okay. And Alexandria is the REIT. Most of these REITs, and maybe you can look up really quickly what the size of the company is by market cap, or go to their 10K, or go to their annual report, and tell me how big are the assets. What's the balance sheet? Go find the balance sheet and tell me how much. Excuse me. In dollar amount, or in market capitalization. So the price of the bonds times the bonds outstanding will be the market value of the bonds. And then the number of shares outstanding times the current share price is going to give us the market value of the equity. The two together is going to give us the total market capitalization of the firm, and that's going to tell us how big this company is. Okay, not only the assets, the value of the assets, but also the total value of its debt and equity that's currently outstanding. So if you can find those numbers, that would be great. And if you can get the balance sheet, maybe you can come up with the capital structure for me, and look at the value of the preferred and the value of the equity and add that together. And then divide that by the total liabilities to get the how much equity is being used to finance the assets. And then 1 minus that is going to give you the debt. So we need the capital structure because we're going to calculate the weighted average cost of capital. And we're going to do $1 billion real estate investment. As Eastdil Secured as the investment banking firm that's advising Alexandria on this $1 billion development. We have 2 major sponsors in this project. And a lot of this project has actually already been developed, okay? So a lot of the stuff that we're talking about has already been done by the investment company. So do you have any numbers? Have you been able to go to investor relations and look at the 10K or the annual report and pull up the balance sheet and give me an idea of the capital structure for the firm? And if you can find any 7-year or 10-year bonds, maybe in the footnotes or something that can give me a yield to maturity, you know, on their bonds. Maybe tell me if what they're rated. Are they a BBB or an A or a AA rated bond? Maybe you can give me that information too. So you're my research team, you're my investment banking team. And I need people who are experts at debt and capital structure and financing and investment underwriting to be able to find out if this project that Alexandria is thinking of doing, if it's feasible investment-wise. Okay. Maybe some of you need some donuts or something like that to get your sugar levels up enough to be able to figure this out. Well, first thing I want to know is how big is the company? Either by assets or total value of their debt and their equity combined as total market capitalization.
Last year, total assets, 8.9 billion.
8.9 billion? Is that big?
It says Q1 of 2016 is 9.14 billion.
Now, is that the value of the assets or the total value of the debt?
That's total liabilities and equity.
Okay, so the total assets, right? Assets is what, 9 billion?
9.14.
Okay. Can this company do $1 billion? $1 billion project?
Yeah.
Of course.
Yeah, exactly. Totally. And can you give me the capital structure since you've got to the balance sheet? Can you give me an idea of how it's financed? Usually most real estate investment trusts are conservatively leveraged. So if they're conservatively leveraged, what would be the proportion of debt and equity? Right off the top of your head. So we said that most corporations are leveraged 70-30, 70% debt, 30% equity. So if real estate investment trusts are normally conservatively leveraged, what do you think the capital structure would be?
73%.
No, it wouldn't be 70% equity and 30% debt. And it wouldn't be 70% debt and 30% equity. It would probably be
60-40.
probably 60-40 or 50-50. Exactly. So can we confirm that? Can we confirm that? I'd like to confirm the capital structure. And if you can find in the footnotes, or maybe you can Google and see if there's any Alexandria debt or bonds that are currently being traded and what the yield maturity is going for right now on their 7 or 10-year debt. That'll give us a proxy of the debt. Okay. And they're also going to, if you can give me two, which would be really important, if you can give me the funds from operations per share, because that's basically the free cash flow metric that is used for REITs. And if you could give me the current stock price, we can calculate the proxy cost of equity by using the FFO per share divided by the share price.
Current stock quote is $103.25.
Is how much?
$103.25.
Okay, so I got the stock price. Excellent.
And I also have the market value.
Okay, is this going to be the total market capitalization of the value of the debt and equity, or just the equity? It's a good question.
Equity?
Well, it's going to be close to the assets, right?
Yeah.
It's going to be close to the asset value. So what do you get?
8,050.
Well, no, that's going to be what? 8 billion?
Let me go
About
back.
8 billion? So I'm looking for the market value.
Oh yeah,
Of the
it's
debt?
in millions. So yes, it would be 8 billion, 8 billion, 50 million, .77.
8 billion for the debt? Or just
For
total?
market value.
Is it the debt, or the equity, or the debt and the equity? Because usually the market value,
Yeah,
you're going to have the number of bonds outstanding,
okay,
times the price of the bonds, is going to give you the market value of the debt. And usually they'll tell you what that is.
okay.
And then you're going to have the number of shares outstanding times the current stock price is going to give you the market value of the equity. So can you find any of that information for me? Because this will all come. And can you find me the FFO funds from operations? Or FFO per share on an annual basis so that I can divide it to get a proxy cost of equity. And we'll do the capital asset pricing model too. Maybe you can find me the beta. Can you find me the beta? For maybe you gotta go to Yahoo or Morningstar, probably.
0.79.
What is it?
0.79.
So the beta equals 0.
79.
Okay, so 0.8. So does the total return on stock compared to the S&P 500, I'm going to assume that that's the benchmark, does the total return on the stock move more or less than the market? With a beta of 0.8. It moves less than the market, okay? So REITs inherently have betas less than the market because they're conservatively leveraged and they're basically asset-backed securities collateralized by real estate. Okay, not tech companies, by product lines and products, but by hard asset real estate. Okay, so that's one thing that's unique about REITs is that betas are less than 1 because they're conservatively leveraged, and the securities are backed by hard asset real estate. Okay, anybody find the FFO per share yet? It should be in the 10K report, which is the quarterly report. Go ahead, and make sure you're giving me the annual FFO, not the quarterly FFO.
Okay, it says growth in FFO per share went from 4.40 in 2013, up 19% to 5.25 in 2015.
5.25. Okay, anybody have any numbers for 2016? Where are we? January, March, April, May, June. July, August, September, so their earnings for September probably didn't come out, but you can probably get the FFO per share for the first and second quarter. Add those two together and multiply by 2 to get a proxy for 2016. You see what I did? I just took the 2 and then multiplied it by 2. Just assume that to get an annual. So do you have the 2016 numbers? And could you do me a favor? Could you calculate 5.25 divided by 103.25 and give me the percentage for that?
I have the FFO in millions and per share.
You do, okay. What's the per share? For 16, is that an estimate?
It's the 2016, or second quarter for 2016.
Okay, cool. So add the second and the first quarter and then multiply it by 2 to get a.
That one's 5.08%.
This one?
Yeah.
For all of 2015? This is all of 2015?
Yeah.
Okay, and you came up with what? Is that diluted or undiluted FFO per share?
I did the 5.25 divided by 100.
103.2, oh, you did?
Yeah, I did.
Yeah, what did you come up with?
5.08%.
Okay. So this could be a proxy cost of equity. It's basically the dividend divided by the share price, or earnings divided by the share price, or free cash flow per share divided by the share price. It'll give us, you know, a lower bound cost of the equity. Has anybody found any bond yields? You found any bond yields? Maybe you can just Google, you know, Alexandria, or what was the ARE bonds, or ARE 10-year bonds, or ARE 70.
You'll get Virginia.
Yeah, when you say ARE,
I looked up Alexandria bond yields. And
they're giving you municipal bonds.
Was it
Yeah.
4%?
What is it?
It said 4% for, I think.
Okay, you're seeing 4%?
Yeah, that's what I'm saying. That was from 2015.
Okay, that's about right. Okay, so 4% for the bond yield maturities on the bonds. And I checked today in the Wall Street Journal. They gave me corporate bond yields for, you know, not AAA or AA or A rated, but like triple BA, and they came up with 4% too. So this kind of gives you a confirmation. And is the cost of the equity higher than the cost of the debt? Yeah. So that's right. If it was the other way around, I'd be concerned. All right. Oh, and then do we figure out the capital structure? Do we go to the balance sheet for 2015 or 2016? I would look at the annual report, and I would look at the liabilities. I would add the preferred and the common equity together, and then I would look at the liabilities, the bonds, and I'd calculate the capital structure. You know, what is the weight? How are they financing their assets? And we know it's probably 60-40 or 50-50. It may even be 60-40. It may be 60% equity, 40% debt. Although that's not going to be the target capital structure. It's probably going to be 50-50 or 60% debt or 30% equity. But I'd like to confirm what it is, both from a cost basis, and in the 10K report, they're going to give you the market value of the debt and the equity, and you can figure out the capital structure that way too. We don't have to do that, because that's a little complex, and we can get into that later. But I really need to see what the 2015 balance sheet is for the liabilities, and I need you to calculate the weights between equity and debt. So are you finding the annual report?
Yeah, I found that.
You found it?
Yeah,
And you're calculating. Don't forget to add the preferred stock to the equity.
it's 218 pages long though, so.
Yeah. Well, there should be one balance sheet for 2015. You might even be able to get it, I think you guys all know how to use S&P and Value Line and those to get company reports. I've been told that you know how to use the library to do that stuff. I'm gonna have Sarah come in and reteach you. Anybody making any progress on the capital structure? You can use the 10K or you can use the annual report. Go for it.
What's the difference between non-redeemable and redeemable preferred stock?
It's just a different class. You know, either you can redeem it at any time, or there's a certain time period in which you can redeem it. Just take the dollar amount and throw it into the equity. We don't need to get into the details. So did you find it?
I have the numbers for the annual report. I don't know.
Well, if you have the total amount of the assets, right, and then we can just break out the bond component, and we can break out the equity component, and it should be around, you know, 9 billion if you're using 2015. That's all we need to do is get these breakdowns so that we can figure out the percentages. So I can calculate the weighted average cost of capital, then we'll determine the cost of debt and equity. Then we can figure out the WACC, use that as a discount rate, and we can do the economics around the $1 billion project. Go for it.
Did you want the total debt to total equity for
No, I
capital
don't want
structure?
that.
Or what is it that you're looking
I'm
at
just
under
looking
capital
for the,
structure?
it's either the total dollar amount of the equity divided by the liabilities, or it's the total amount of the debt divided by the liabilities. That's all I'm looking for. Because I can figure out the equity, like just one minus the weight of the debt or one minus the weight of the equity, I can get the other side of the equation. And I'll know kind of what it is too. I just want to see if you can find the information and then do the calculations. And you might be able to get it through Value Line, you might be able to get it through S&P, you might be able to get it through some of these others that will actually give you the breakdown of the assets and the liabilities. I know the Value Line reports, you know how to get it in the library, does have the assets and the liabilities broken down by general categories. No, you're not
So
finding
you
it?
want us to divide the equity by the liability?
Yeah.
Oh, it's 0.8.
Are you getting 0.8?
Yeah.
0.8 equity? So the equity divided by liabilities is giving you 0.8?
Yeah.
Or is that the bonds? And it's probably not gonna be that.
That's the bonds.
So the bond, 80% of the capital structure are bonds. That seems high for a collateralized company that's, we think it's gonna be 60-40,
Equity divided by.
or it's gonna be 50-50. And if we don't figure it out, what I'm gonna do
Oh,
is,
it was 58-42.
58, 58?
Yeah, 58 equity, 42.
Okay, right on. I bet that's it. Nice job. That totally makes sense, right? Because it's almost 50-50.
It was close.
Isn't that what we thought?
Yeah.
And then we also said it's probably 60-40. So nice job. That's awesome. Now we can move forward and do the analysis. So we've got a lot of the numbers already done. And then what we'll do is we'll play some more. So if I'm going to calculate the cost of the debt and the equity, we already have an idea of what the cost of the equity and the debt is. We have an idea, but I want to go back and come up with some more numbers, just to verify that we're in the right range, okay? So the first thing what we're going to do is we're going to use, Alexandria is a really big company. It's got $9 billion in assets. Okay, these companies, these REITs, use lines of credits by banks. Okay, they have a huge line of credit. Which basically they've gone to Wells and BNA and some of the larger banks, maybe JP Morgan, Goldman Sachs, you know, they have huge lines of credit. And these guys are so big, they probably have, you know, $3 to $4 billion. In a line of credit. So basically, they can buy and build these projects based on their line of credit. Okay, so they can go out and buy billions of dollars worth of real estate, develop billions of dollars worth of real estate. It's not, the money's not the issue because they have a line of credit. Okay? And then what they'll do is once they take down the assets, right? Let's say they take down $1 billion project, and their line of credit goes to $2 billion. They bought $1 billion project. What they will do is they will issue stocks and bonds in the capital markets. Maybe they'll do 500 million stock, 500 million bonds, and then what they'll do is once they raise the money, they'll pay off the line of credit and bring it back to $3 billion. So they're constantly using their line of credit. It's very unique for real estate investment trust companies to have that access to that line of credit.
So they raise money through their own stock or by betting
Yeah.
on other people's stock?
Now they will issue their own stock. The thing to understand is they have a line of credit of $3 billion. They just bought a $1 billion project. So their line of credit dropped to $2 billion. Then what they do is they go into the market, they hire us, East Hill Security, the investment banking firm, to basically underwrite and then issue 500 million in stock and 500 million in bonds in the capital markets. And then take that money and pay off the line of credit. So they're constantly using the line in the capital markets to raise money. Okay? It's really kind of cool. So what we need to do to be able to do the analysis for this $1 billion project, first thing we got to do is we got to figure out where interest rates are going to go, right? So when we calculate the cost of the debt and the cost of the equity, what's the first variable in the cost of debt and equity equation? What?
Interest rates.
Yeah, but what's it called?
Risk-free rate.
The risk-free rate, right? And what are we going to use in this example to calculate the cost of debt and equity? What risk-free rate are we going to use? Because our holding period in this example is going to be under a 10-year holding period. That's the pro forma holding period that we're going to use. So what risk-free rate do we use? Okay, you need to write these notes down because this is what's going to be on the in-class exam. Okay? So what risk-free rate are we going to use? Okay, what's the risk-free rate analogous to? What's it also called? What?
Interest rate
On what?
on whatever it is that
Yeah, but
we're
what are considered risk-free? What bonds are considered risk-free? What?
Government bond?
What kind?
Treasury.
Treasuries. U.S. Treasury securities are considered the risk-free rate. We're assuming a 10-year holding period. So what interest rate would we use as the risk-free rate to start calculating the cost of debt and equity?
US Treasury rate.
Yeah, which one?
Yield.
Yeah, what maturity? What maturity? What?
10 years.
10-year. Okay. I'm giving you a lot of the information. What I'm doing is just training you on the precision of your language. Okay. Because when you're sitting in meetings with these finance guys, they're going to be using all this terminology, and either they're going to be talking over your head or you're going to know exactly what they're talking about. Okay, and that's what I'm trying to train you, is to have those conversations and be part of the conversation. Okay, because if you're not part of the conversation, they don't need you in the meeting. Okay, if you're part of the conversation and you're doing research like you're doing right now, providing information, now you're totally valuable. Okay, now they have to have you on the team. Okay. So we need to figure out, maybe you can give me just really quickly what the yield curve is. So give me the yield maturity on the 30, the 20, the 10, the 7, and the 5. Because that's all I really care about. Because what I'm going to try to do is use the yield curve to try to forecast where I think risk-free rates are going to go. So what we're doing is we're using what is called the term structure of interest rates to forecast forward rates that we're going to use as the risk-free rates in determining the cost of debt and equity that we're going to use to calculate the weighted average cost of capital, which is going to be the discount rate in which we are going to discount the cash flows for this project and then make investment decisions based off present values, net present values, and internal rates of return. Okay, so it all ties together. So I need to kind of figure out a forward rate. All right, so if you can give me the yield maturities on U.S. Treasury securities for different maturities. And I'm looking for the 30, give me the 20, give me the 10, give me the 7, and just throw the 5 in there too. Go ahead.
2.51
For which one?
30 year.
Is that the 30 year?
Yeah.
Okay, 2.51, all right. Let's just say 2.5.
2.19 for the 20 year.
So 2.2,
1.8 for the 10 year.
okay.
And 1.6 for the 7 year. Did you want the 5 year too?
Go ahead. So we can get, you know, a view of what
1.3 for the 5 year.
All right, so you have kind of a view. Now, do we think that by consensus, again, you're the underwriting team, do you think that interest rates are going to go up or down, you know, over the next 12 months? Because we're going to do this transaction within the next 12 months. Okay, and we're going to use the 10-year. Okay, so we could probably use the 20-year as a proxy, right? Because it's the 20-year yield is basically a geometric average of the historics. Okay, so historical, or not historical, but different maturity, yield to maturities. If you calculate the geometric average, allows you to project the forward rate is what we're doing, okay? So if our holding period is 10 years, and we think that interest rates are gonna go up over the next 12 months or 24 months, we probably wanna use, the 20-year, okay? And instead of using 2.2, let's just use 2.0. So now what we did was we did interest rate forecasting using the term structure of interest rates to do calculations, and we came up with a forward risk-free rate that now we can use to calculate the cost of the debt and the cost of the equity, okay? So nice job on that. So now we gotta figure out the cost of capital. All right, and we're gonna come up with the cost of the debt, and we're gonna come up with the cost of the equity, okay? Now, we already know from the information that we've already calculated that the cost of the equity is at least 5%, and the cost of the equity is at least 4%. So that's basically a starting point. Okay, so now we have kind of an idea. Although I think the cost of the equity using this calculation is a little low. Okay, this is probably about right. It's probably a little low too, but we have something to at least start from. Okay, so how do we calculate the cost of the debt? Okay, and you're gonna have to help me out here because I already went over this on Monday. Okay, and you probably took notes. Okay? So if you didn't take notes, you should take notes. Okay, you need to take notes. Okay, so I don't have to explain everything all over again, so that you can refer to your notes, so that we can speed up the process, so I can get through the lecture. So you have to help me here. You have to participate. So give me the equation for the cost of the debt. And what risk-free rate are we using? Thank you.
Risk premium and inflation,
Yeah, and which risk premium is the most important?
credit default.
Yeah. And can you look up? The for Alexandria what their bonds have been rated at? They're probably not AAA. Okay, they're not riskless, and they're not institutional. They may be AA. They're probably A and triple B. Okay, or BAA, depending on what rating agency. So in their investor relations, they should tell you, and in their press releases, should tell you if they issued any bonds recently, what the ratings have been.
They're BAA.
They're BAA too?
Yeah.
So the credit rating is BAA2. Is that Moody's?
Yeah.
Do you have S&P? Because they usually list both rating agencies, because usually the bonds are rated by both agencies. Do you have an S&P rating? Obviously, this is not institutional, right? So there's some credit default risk associated with the bonds. That's why they're getting the lower rating. Anybody else find any S&P 500 ratings? Could you do me a favor and, excuse me, could you do me a favor and turn off your phone? It's really distracting. Can you give me the S&P 500? Can you find the S&P rating on the bonds, or we just use this one? Huh?
Needs to lower.
Okay,
I don't know if this is it, but it says triple B.
that's probably right. That's probably right, okay. All right, great. So we have an idea, right, of what the credit default risk premium is based on the ratings that the rating agencies have already given the existing bonds that have been issued, before. All right, now we're in business. And then what's the next risk premium that we would use?
Inflation.
We can do inflation, but again, let's assume the inflation risk premium is embedded in the expectations within the risk-free rate.
Maturity?
Okay, yeah. So maturity. Okay, any others?
Liquidity.
Yeah, liquidity. I like to call it illiquidity, risk premium. Because it's more logical. And then any others? Yeah, I mean, you could probably put inflation, you could probably put tax, you could probably put, you know, foreign currency, but they're not international, they're all domestic, so it's not foreign currency, okay? And then tax risk premiums, you know, I wouldn't put that in there either because they're not that big. These are the major risk premiums, and the largest risk premium is going to be the credit default risk premium. We already know just from the proxy yield to maturity that we've already got, both from basic corporate bonds and the corporate bonds that have already been issued, that the cost of the debt is roughly 4%. So we already know we can start solving for the other risk premiums. So why don't you tell me what the other risk premiums are? And we know that this is going to be 2%. We're using a forward 10-year treasury yield, proxied off of the 20. So can you tell me what the risk premiums are for these risk premiums? And we know that the credit default risk premium is the biggest one. So how would you allocate it across those risk premiums? Hurry, 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 because I'm gonna run out of time, and then we're not gonna get to the end of the lecture. I need answers very quickly. You know that if this is 4 and this is 2, then you got 200 basis points to distribute across the 3 risk premiums, and the majority of the risk, the weights are going to go to the credit default risk premium. So it's either 1, 0.5, or something. So you got to come up with something. I need you to like think through the theory. Go for it.
0.8.
Which one?
The credit default.
Okay, 0.8, and then what's the rest of them? You got basically 120 basis points now to distribute across the other 2.
0.6.
6. Okay, and then what's the last one?
0.6.
There you go. This is kind of how it works. Okay, you don't have a lot of time, but you can come up with stuff really quickly. And in the meetings, you're going to have to come up with answers really quickly. Okay, because the principals and the investment bankers and the corporate finance people in the department are not going to tolerate time wasting. They're not going to tolerate any wasted time. Okay, because time is basically really, really important when you're underwriting these types of deals. You got to get to the answer very quickly. All right. So, but bad news. It's probably true, but it seems to be a little low. Would you rather be conservative in your estimates, or would you rather weigh on the liberal side?
Conservative.
Probably want to be conservative. So should we add like 100 basis points?
Yeah.
You know, just to be careful, and say that the cost of debt is 5%, just to be conservative. And you'll probably run it when you're building the model in Excel. You'll probably do sensitivities at 4, 5, and 6 for the cost of the debt. Okay, and we're just doing it very in a simplistic manner right now, just to get some answers, so we can get through the integration process. So what is the cost of the equity? How do we come up with the cost of the equity? What model do we use? Okay, everybody's got to know this. Okay, all in unison. 1, 2, 3.
Capital asset pricing model.
Excellent. So it's capital. Okay, so we're going to use the capital asset pricing. And then do you have to memorize that?
Yes.
Yeah.
Yeah, you got to memorize that. Okay. This is also called the risk premium or risk premium model. Risk premium. Or premium. Okay, in calculating the cost of the debt. All right, and what's the equation for the capital asset pricing model?
Risk-free rate plus the beta times the expected market return
Excellent,
minus the risk-free rate.
excellent, awesome, nice job. And then what did we say the risk-free rate was that we were going to use for the calculation? What were we going to use for the risk-free rate? 2%. Okay. And then what has been the average annual rate of return on the S&P 500 per year over the last 10, 15, 20 years, give or take? It's been the average annual return on the we're gonna use the S&P 500 as the benchmark, okay, for market return. So what's been the average rate of return on the S&P 500 per year over the last 10, 15, 20 years?
8 to 10.
What is it?
8 to 10.
8 to 10, so what do you want to use?
8. More conservative.
And we know that what is this right here? Market return minus the risk-free rate, what's that called? What's that called?
Market risk premium.
Nice, awesome. And then when you add the beta times the market risk premium, what's that called? What's that called? Okay, write this down, market price of risk. Market price of risk. So what did we come up with for the beta? What did we come up with for the beta?
0.8.
0.8?
Point
Do
eight.
you want to use the calculated beta, the true beta, or the forward-looking beta?
Forward looking.
Probably the forward-looking. Okay, so the question then becomes, is the current beta of 0.8 the true beta and the forward-looking beta? It could be, but the question for you is there going to be more market risk in the future?
Yeah.
So do you want to keep the beta at 0.8, or do you want to be more conservative and use something a little bit higher? It's up to you, you're the underwriting team. What? You want to use 1? Okay. All right, so we know that that's 6, and we know that the cost of equity, based on the capital asset pricing model, using a forward-looking risk-free rate, forward-looking beta against the market risk premium, okay, is going to be 8%. Excellent. Now what we can do, since you've already done the analysis, I don't have to draw the balance sheet up here. You already went into the balance sheet and figured out the capital structure, right? So you figured out the capital structure using the annual report, okay? And what is the capital structure? What's the weight of the debt and the weight of the equity?
42.58.
What's it? What's the weight of the debt?
58.
58%. And what's the weight of the equity?
42.
Okay. When you use the balance sheet, are you using the market value of the debt and the equity, or are you using the historical cost basis?
Historical cost.
You're using the historical cost basis. That's okay. Okay, but usually what I would do is I would run it both ways and see what it looks like to confirm the capital structure. Okay, so I'd look at the market value of the debt and equity together and then divide it to get the weights using the market value, but you can also use the historical cost basis based on the liabilities of the balance sheet. Okay, and then the question becomes, is this capital structure the target and the optimal to minimize the weighted average cost of capital? So my question to you is this capital structure their target and their optimal capital structure to minimize the weighted average cost of capital? Yes or no? What do you think? I mean, obviously what you would do is go back and look at maybe 3 years of annual reports to confirm it, because it's not going to change that much over time. But can we assume that this is their target and their optimal capital structure? Yeah, exactly. Because they're not going to deviate from it, right? And these guys are really going to focus on optimizing the capital structure to minimize the weighted average cost of capital. Because the goal is, if they can invest right in projects, they can maximize the internal rate of return on their investments, they can minimize the weighted average cost of capital of their liabilities and the cost of their capital, they can maximize the spread between the two, both in percentage terms and dollar amounts, and maximize in dollar amounts their economic value add, thereby maximizing the stock price, which is their goal. All right, excellent. And then we know what the cost of the equity is, right? Which is 8%. And we know that the cost of the debt is 5%. So can you give me the weighted average cost of capital for me? And did I tell you that REITs, real estate investment trusts, if they adhere to the REIT guidelines, do not pay any corporate income taxes? They do not, as an entity, special entity passed by Congress in 1960, that basically said if they pay out the majority of their earnings as dividends to shareholders, they don't pay any corporate income taxes. Okay, so you don't even have to put the corporate income tax shield in here. Okay, so it's a special entity. So what is the weighted average cost of capital? What's our WACC? Do you have your calculators? Can you calculate the WACC for me?
So together, that would be 6.26%.
6.26, is that correct?
Yeah.
Right?
Yeah.
So we could do a sensitivity at 5%, 6%, and 7% is probably what we would do. But in this case, let's use the 6% as our discount rate to evaluate the financial feasibility of this billion-dollar project that they want to do in Mission Bay that we're helping them to undertake. How am I doing on time? Okay. Now, I don't want to do a 10-year holding period because we'll go across the whole board and it'll take us 20 minutes just to do the DCF calculations. So let's just condense it into a 5-year holding period. Okay, because we're going to calculate the terminal value on the back end anyway. So it really is not going to make that much difference if you do a 5-year or 10-year because of the terminal value. So let's just, in most cases, we would do a 10-year holding period, and we would create a 10-year pro forma or a projected income statement. Okay, and I'll show you that later on in class. There's some Excel spreadsheets that we can use. But let's just say for simplicity purposes and to streamline the process, then we'll use a 5-year holding period. All right? And you've already done a lot of the research on the market and what kind of rents that we can get in these biomedical buildings. Again, they're going to cost us $1,000 a square foot to construct. But we know we could probably get 100 or 150 bucks per square foot out of the 1 million square feet building. You can get some pretty good rents because they have labs and medical office, which are very high-end build-outs, very high quality, high-priced real estate to rent. It's very valuable. So we kind of have an idea of what the net operating income will be from these properties. Okay, and we know that the cost of construction, and it's going to be a 1 million square foot project. Is that a big project? Yeah, that's a big project. And then it's going to cost us, $1,000 a square foot to construct it, to build it, which is a lot. So it's going to cost us $1 billion to build this building. The development costs are going to be about $1 billion. Okay, and that's a pretty big project. Okay, most office buildings in San Francisco, New York, Chicago, and other places, if they're about 70 or 100 stories, they basically cost around $1 billion to build. So this is a pretty big project. Okay, it would be considered institutional quality product. Okay, now let's set up the present value calculation, then I'll do the table over there to do the investment analysis. And we need to figure out what the present value is going to be based on the projected cash flows associated with the project. And based on your research, okay, based on your research, you did the market survey, okay, you did the market survey, and you figured out that the gross potential rental basically the million square feet times the rents. Right? You're gonna figure that out, gross potential rental income. You're gonna take out some vacancy loss factor. You might have to add in some concessions. You might have to add back some other revenue. To get to some gross effective rental income. Oh, and I forgot to tell you, in the corporate finance books, they forget to add in real estate and they forget to add in insurance too, which are two huge capital markets underneath the finance field. They just ignore it. Now that you have the gross effective rental income, you want to take out the expenses. Now your expenses are going to be utilities and water and gas and payroll and maybe reserves, you know, to be able to use later on to cure some of the functional obsolescence or some of the problems associated with the buildings. And then after that, you're going to get the net operating income. Or the NOI. And that's going to be the cash flow that we are going to use to value the commercial real estate. Okay? So, again, you did the research on the market, and you found out that you could rent these properties out for roughly 50 bucks a square foot, which is pretty high. So you could rent out these properties for 50 bucks a square foot, okay? Or let's say 100 bucks a square foot, okay? So basically your gross potential rental income is $100 million, which you're coming up with. And then you're going to take out the vacancy loss factors and everything, and you're going to get to, let's say, 75 million. You're going to take out the expenses, and you're going to get net operating income of $50 million.
How long is this to assume that you're renting it out for?
Well, we're only going to use a 5-year holding period.
Okay.
Okay, to calculate the present value, net present value, internal rate of return. And so we're using a 5-year pro forma. We would usually use a 10, but the building is actually going to last around probably 30, 50, maybe even 100 years. Okay? But we can't model that out. That's ridiculous. So what we do is we shorten the holding period and then calculate the terminal value. Okay? That allows you to take all that future cash flow and bring it into a 5-year holding period. Okay? So that's really something you want to write down too. Okay? Because the terminal value, you cannot go out, you cannot do a pro forma of 30 to 100 years. Okay? So the way you do it in finance is to truncate it, come up with a 5 or a 10-year holding period, and all that future income after that holding period is all in the terminal value. Okay, is all in the terminal value. And you have to assume, is the cash flow going to be flat or is it going to grow? Okay, and that's something we're going to ask later on. All right, so we know what the cash flow is going to be, or the net operating income is going to be in T equals 0, right, which is going to be 50 million bucks. Now the question is once we've built it, okay, and after we've leased it up, what do you think the net operating income growth rates are going to be per year for the next, how many years? No, we're using a 5-year holding period. So how many cash flows, how many NOIs do we need to calculate? How many? 6. Remember, because we got to go out one more year. All right, so what's the first year? So what's the cash flow going to be in the first year? What's the growth rate going to be? What do you think we can grow the net operating income out from the 50 million to the first year? 15%? 1.15. So get out your calculators and start calculating this. And if you want, I mean, I can like stop right here and we can do a bunch of PowerPoints for the next hour and then go to maybe a multiple choice exam for the midterm. Wouldn't that be really fun to go back? Yeah, I don't think we want to go back, do we? No, I don't think so. Okay. All right, so what's 50 million times 1.15?
57.5. 57.5.
Okay, thank you. And then what do you think we will do between year 1 and 2? And remember, this is a pretty big project, so we could probably add value we could do, probably increase the NOI a lot in the first 3 years, but it's gonna taper off. So what do you think we can do in growth rates between 1 and 2?
20%.
How much?
20%.
Huh?
20%.
You really think so? I mean, it's kind of a lot. This is a big project, and we're already at the top of the market in regards to rents. I mean, we're not leasing out. You know, this is not a value add deal. This is new construction, stabilized, tenanted credit, you know, tenants in there.
I misinterpreted what you said when you said that profit grows. I thought you meant the percentage. So then
Yeah.
let's do like 10.
Yeah, we did 15 in the first year, and then what do you think we can do the second?
10.
Okay, so 1.1 times 57.5 gives you
63.25.
63.2. Okay, and what do you think from 2 to 3?
8.
Still pretty aggressive, right? I mean, this is a big project, it's high quality, you know, the tenant build-outs are really high with lab space and medical office. This is not just office, and it's not a repositioning, this is new construction.
6.67.
6%?
Yeah.
Okay. And then what is 63.2 times 1.06?
67.
67. Are you guys checking the numbers for me? Do not send me down the rabbit hole. Okay. And then what about from year 3 to 4?
3%.
And we've done these projects before in Washington, D.C., and we've done them in Chicago. We've done these projects in Seattle. So we have some experience doing these, but we've never done a project like this big in San Francisco, which is, there's nothing like San Francisco, right? Because of the tech and everything and the location. 69. Okay. And then what's the growth rate between 4 and 5? What is it? Well, again, usually you go high in the early years because that's when we're going to add the most value, and then it degrades.
2%?
1.02, so what's 1.02 times 69?
70.38.
70, let's just use 70. Okay, just round up, okay? All right. So now do we just take the present value of that to make our investment decision? And subtract the present value of future cash flows by the development costs to get the net present value?
You add another.
We go one more year? Yeah, to get what? What are we trying to do? What are we calculating?
The terminal value.
The terminal value, okay. So what do you want to grow this out at?
Like 1%.
With 1? Okay, so what's 1.01 times 70?
71.
So we got 71 million, all right. And we need to figure out the terminal value. All right, so how do we calculate the terminal value? What's the next procedure? What's the next decision that we have to make? How do we calculate the terminal value? Okay, how much time do I have? So
20 minutes.
yeah, do not run out of time. You got,
Free cash flow.
what is it?
Free cash flow plus 1.
No. How do I calculate the terminal value?
The final projected year cash flow, which would be 71 million times 1 plus the long-term cash flow, which would be.
No, I'm trying to calculate the terminal value. And there's usually 3 models that I can use. Perpetuity or Gordon growth. So the question is, do we want to assume that the cash flows are going to be flat forever? under a conservative scenario? Or do we want to assume that the cash flows will grow at a constant rate forever? What? Constant rate? Okay, so what model were you going to use? Gordon growth. Okay, and what is the growth rate? And again, this is a big project, remember? So you have to have that. This is not a value add or some other type. This is a big freaking project. Okay, so what do you think the growth rate in the net operating income forever would be? Well, you know it's not 0 because that would be perpetuity. And you know it's not 5, okay? And 4 is probably still going to make the terminal value really, really high. So what is it? What?
2%.
You want to use 2?
3, 1.
Want to use 2 or 1? 1?
Like one.
1.5. 1.5? Okay, 1.5. 0.015. Okay, and then what do we do? Minus what? What do we put here? What's this? What do we use? What? We use what? What discount rate do we use?
6%.
Yeah,
Okay, so we have, that's the going in discount rate.
yeah.
Do we want to use the going in discount rate or something else? You want to be more conservative? So how many basis points should we add to the going in discount rate to reflect the risk in which we would be confronting in 6 years and more from now? Because obviously in 6 years after this is built, there's going to be more competition and the building's going to degrade physically and functionally. So how many basis points do you want to add to the going in discount rate to reflect the additional risk?
200?
You want to do 200? Anybody else? 0.08, okay, and what's the adjustment? What is this? 6.5? Is that right? 6.5? 0.065. Okay, so what's the terminal value? It is 71 million divided by 0.065.
1,092 million.
What is it?
1,092 million or 1,092 million.
Like that?
Yeah.
Here's your terminal value. Now, what do we do with the terminal value? What do we do?
Add it back in.
Add it?
2.
Yeah, that one.
We add it to the last year's cash flow. And what does that give us? What is it? 170.92, is that right? Is that right?
No.
This times this?
I got.
It's added.
Add it.
All right, you add it together. Okay, so what is it?
1162.
Is that right?
Yeah.
Okay. Okay, so let's calculate the discount factors. Okay, real quick. So what's 1.06 to the 5th power?
1.34.
What is it?
1.34.
Okay, and check it for me too. Are you checking the numbers? Okay.
Yes.
1.06 to the 4th power.
1.26.
What is it?
1.26.
And then 1.06 to the 3rd power. Cubed. What's 1.06 squared?
1.12.
And this is 1.06. Okay, excellent. So what is 1,162 divided by 1.34? Yeah, just round up. Keep the math easy. And then what is 69 divided by 1.26?
54.76.
What is it?
54.76.
Is that right? I need more than one person to verify that. Is that correct? Yep. And then what is 67 divided by 1.19? Is that right, Gabe?
Yeah.
Okay.
56.3.
56.3? Yep. Okay, and then 63.2 divided by 1.12? 56.4?
Yes.
Okay. And then what is 57.5 divided by 1.06? What is it? Okay. Phew. I should have probably got a PowerPoint tonight. Okay, so what's 54.2 plus 56.4 plus 56.3 plus 54.7 plus 867? What's the present value?
1,088.6.
What is it?
1,088.6. 1,088.6.
And what's the cost of construction?
1 billion.
And what's the net present value? The cost of construction is $1 billion, and the present value is 1,088, and the cost of development is $1 billion. So what's the net present value? Plus or minus? Do we accept or reject the project? All right, next. How much time do I have? Okay. Tired. All right. So let's set this thing up correctly. Okay, and this is going to be your financial feasibility matrix. Okay, for investment decision making. What we just went through is also called investment underwriting, the underwriting process. Either underwriting the real estate or underwriting of the capital structure, the capital that we are going to raise to finance this thing. We underwrite the securities and we underwrite the project. Okay? And you'll hear that a lot. Okay? So we need to go back and underwrite this project. And that's what we did to come up with financial decisions. So the first is going to be is the present value greater than the price? Is the present value equal to the price? Is the present value less than the price? Okay. And then is the net present value positive? Is the net present value equal to 0? Is the net present value negative? The internal rate of return greater than your weighted average cost of capital? Is the internal rate of return equal to your weighted average cost of capital? Is your internal rate of return less than your weighted average cost of capital? And since this is such a big capital intensive project and not a technology project, we're going to have a longer break-even period. So if we know what the cost is minus the cash flows as they come in, we want to calculate the break-even. When do we break even and recoup all of our costs? Under this scenario, we're going to use a 5-year break-even period. So if the break-even is less than 5 years, the break-even is equal to 5 years, and if the break-even is greater than 5 years. All right. So now we can do the first iteration. Let's say we do the first iteration under the current scenario. Okay. So is the present value, greater than the cost of development?
Yeah.
Okay, everybody needs to, this is the sing-along section, okay? Just like the Sound of Music sing-along, have you ever gone to those? It's the same thing, okay? Okay, so we're all gonna sing along. So if the present value is greater than the current cost, then we accept or reject.
Accept.
Excellent. All right, if the present value is equal to the cost, do we accept or reject?
Accept.
Excellent. If the present value is less than the cost, do we accept or reject?
Reject.
Excellent. Okay, if the net present value is positive, do we accept or reject?
Accept.
Over here, we poke him over here. And when the net present value is 0, do you accept or reject?
Accept.
And if the net present value is negative, do you accept or reject?
Reject.
Excellent. And you need to say this out loud verbally, because then you'll learn it. If the internal rate of return is greater than the weighted average cost of capital, do you accept or reject? Accept. Okay, if the internal rate of return is equal to the weighted average cost of capital, do you accept or reject?
Accept.
If the internal rate of return is less than the weighted average cost of capital, do you accept or reject?
Reject.
Reject. If your break even is less than 5 years, do you accept or reject?
Accept.
Accept. If your break even is equal to 5 years, do you accept or reject?
Accept.
Accept. And if the break even is greater than 5 years, do you accept or reject?
Reject.
Reject. Bad news. I got bad news. Actually, the construction costs, because of the permits and the politics and the escalations in the cost of construction and union labor and delays and interest rates going up and the stock price of Alexandria going down and capital markets being volatile, the actual cost of construction is $2 billion. Okay, we totally underestimated the cost of construction. So under a cost of construction of $2 billion, what's our net present value?
Negative 912.
It would be what? Negative
912.
negative 912? Negative 912? So are we gonna accept or reject it?
Reject.
Reject it. Is the net present value negative or positive?
Negative.
Negative, so we would reject it. Is our internal rate of return less than the weighted average cost of capital?
Yes.
So we would reject it. And is our break even now greater than 5 years?
Yes.
Yeah, we would reject it. All right. But we really want this project, okay? We really want this project. So what could we do? What would be our second iteration? Or third iteration?
Re-estimate the growth rates.
Here you go. So this is the iteration. This is number 2. This is number 3. We really want the project. So what could we do to get it to get it accepted?
Re-estimate their growth rates.
Yeah, we would go, well, let's go back to the very beginning, and let's go through the variables that we could adjust. Could we have overestimated the interest rate movements?
Yeah.
Yeah, so we would probably go back and re-estimate the risk-free rate. What about the risk premiums? Could we have overestimated the risk premiums? Could we have overestimated the beta? Could we have overestimated the beta?
Yes.
Could we have overestimated the return on the market?
Yes.
Could we have overestimated the weighted average cost of capital?
Yeah.
No.
Could we?
Yeah, we could.
We could have?
Yeah.
Okay, so we could have overestimated the weighted average cost. Could the capital structure be off? Could our capital structure be off?
Yeah.
What other variables could we audit?
Growth.
The growth rate? So we may have to go back and look at the growth rate and the cash flows. Okay, we already talked about the discount rate. What about the terminal discount rate? Could we have overestimated that? Yeah, so the terminal and the going in. Could we have underestimated the growth rate in the Gordon growth model?
Yes.
Yeah, so we could have underestimated the G. It could be underestimated the terminal value. All right. So we got to go back and reevaluate. All right. Bad news. We were right the whole time. So we're still getting negative net present value of $912 million. What would be our fourth iteration that we could do? What would be the fourth method that we could do?
You buy call options?
You would do a what? What would you calculate? What would you value? What's it called? It would be you would calculate the value of a real call option. Okay? It would be the fourth iteration. So you calculate the value. How much time do I have?
5.
I can do it. Call option. Okay. And what are the factors that drive the value of a real call option? What are the factors that drive the value of a real call option? Basically 3.
G.
What are the factors? Did you write these down? Just tell me if you did it, and I'll move on, or else I'll run out of time. Just say, no, I don't know.
No, I don't know.
Make a guess. Okay. First is going to be value, volatility. Now, is this a big project?
Yes.
Could the values move a lot?
Yes.
Yeah. Do we have time? Is this a big project? Doesn't it take a lot of time to do?
Yes.
So we're going to have time value, right? And can management add value through its decision-making process
Yes.
in this project? Doesn't it have a lot of touch points where value can add, management can add? So management decision. Okay. So if I calculate the value of the real call option, what does that value need to be for us to get a net present value that is either positive or equal to 0?
912 million?
So the real call option has to be 912 million positive, right? So if we calculate the real call option and it's $912 million or more, are we going to accept or reject the project?
Accept.
We're going to accept it because our net present value is positive or equal to 0. So then we would accept the project. Okay, last piece and then we're done. What if we do the real call option value and it comes out to be $900 million? Do we accept or reject the project?
Reject.
We reject. So the real call option is the last procedure in the investment decision-making process, in the underwriting process. After the real call option, that's it. It's all political. Okay? They really want the project, they're going to have to take a lower rate of return or take on more risk.
In the first example, would they still use call options to like gain more capital?
The real call option? No, the real call option is just a procedure to take into consideration factors that aren't being reflected in the traditional investment approach. This is a new addition to investment decision making. So it's basically takes into consideration unknown factors that will contribute value to the project, but it's hard to measure, so we have to use option theory.
Okay.
Okay? We have to use a different method. All right? Is that better than PowerPoint?
Yeah.
Okay. And then we'll do this probably a few more times. We're going to do securities next. So we're going to value stock. And then I'm going to have you do some of the stuff. Okay? Because I want you to practice. I don't want the old memos that corrected memos, I just want I want the corrected memos, I don't want the corrected memos. Does that make sense?
You want the new memos.
I want the
yeah.
new memos.
Yeah, you don't wanna see all the old.
memos. I don't want the ones that I marked up. Because I want to focus on the ones that. Yeah.
So you just want the final one, not these?
Yeah, I don't want the ones that I marked up. Are we done here?